What if you sold your crypto for a $10,000 loss, but the IRS received a document suggesting you actually made a $40,000 profit? This isn't a hypothetical scenario. It's a structural flaw in a new tax reporting system that goes into effect in 2025. And it could result in you receiving a massive, incorrect tax bill for money you never made. Let's make this real. Imagine an investor, we'll call her Jane. In 2024, she buys one Bitcoin for $50,000. The next year, she sells it for $40,000. That's a clear $10,000 loss. But because of how the new rules work, the form sent to the IRS might only show the $40,000 sale, with a blank space where her original cost should be. To an automated computer system, a blank cost can look like a zero cost. And suddenly, Jane's $10,000 loss is transformed into a $40,000 phantom gain. So, how is this possible? And more importantly, how do you protect yourself from paying taxes on money you never actually made? In this video, we will break down the exact mechanics of this new rule, and I'll give you a clear, step-by-step plan to ensure you don't overpay the government by a single dime. To understand the problem, you need to understand the new form at the center of it. IRS Form 1099-DA. The DA stands for Digital Assets. For years, crypto tax reporting has been inconsistent. Some exchanges sent forms, others didn't. The IRS knew it was missing out on tax revenue, but had no systematic way to track transactions. The 1099-DA is the government's solution. Starting with the 2025 tax year, every sale you make from January 1st, 2025 onward through a broker must be reported directly to the IRS. These first forms will arrive in early 2026. The term broker is defined broadly. It includes centralized exchanges like Coinbase and Kraken, but can also cover some payment processors and crypto ATMs. The goal is to bring crypto into the same reporting framework as stocks, where brokerages issue a Form 1099-B for every sale. On the surface, standardization sounds like a good thing. But here is the critical flaw for the 2025 tax year. The IRS is only requiring brokers to report one half of the tax equation. They must report your gross proceeds, what you sold your crypto for. They are not required to report your cost basis, what you originally paid for it. That requirement doesn't begin until 2026. This one-year gap is the source of the entire problem. If your proceeds are $40,000 and your cost basis is $50,000, you have a $10,000 loss, which can reduce your overall tax bill. This is how it's supposed to work. The danger lies in how the IRS processes information. The agency uses a powerful automated matching system. Its primary job is to compare the numbers on 1099 forms it receives from brokers with the numbers you report on your tax return. When it finds a discrepancy, it automatically flags your account. So what does this computer do when it receives a Form 1099-DA showing $40,000 in proceeds, but the cost basis field is empty? In the worst case scenario, the system assumes a cost basis of zero. The formula now looks like this: $40,000 in proceeds minus a $0 cost basis equals a $40,000 gain. Your real-world loss is transformed, on paper, into a phantom gain. Consider another common scenario. You bought Ethereum on Coinbase a few years ago. You then moved it to a secure hardware wallet. In 2025, you decide to sell, so you move it from your wallet to Kraken and execute the trade. Kraken has no visibility into your original purchase on Coinbase. It only knows that crypto appeared in your account and was then sold. It will report the proceeds to the IRS, but it cannot report the cost basis it doesn't know. So what does this mean for your taxes? If you file correctly and report your true gain or loss, your return will not match the incomplete form the IRS received. That mismatch is the trigger for an automated review. When the IRS matching system flags a discrepancy on your return, you don't get a visit from a team of agents. The first step is an automated letter, typically a CP 2000 notice. This letter is not a formal audit. It's a proposal. It says, The information we received from a third party doesn't match what you reported. We have recalculated your taxes and believe you owe an additional amount, plus penalties and interest. Please pay this amount or explain why our information is incorrect. Let's go back to Jane. She had a real-world loss of $10,000. Instead of a potential refund, she receives a CP 2000 proposing she actually had a $40,000 gain. At a 20% long-term capital gains rate, that's $8,000 in tax. The IRS will also likely add a 20% accuracy-related penalty, plus interest. Jane is now facing a bill for over $10,000 from a transaction where she lost money. What happens if the IRS computer flags your account by mistake? The burden of proof shifts entirely to you. In the eyes of the automated system, you are assumed to be incorrect until you can prove otherwise. If you ignore the CP 2000, the process escalates. You'll receive a statutory notice of deficiency, giving you 90 days to either pay or petition the U.S. tax court. If you ignore that, the IRS can begin collection actions, such as placing liens on your property or levying your bank accounts. The phantom gain becomes a very real financial problem. Okay, that's the problem. And it's a serious one. We're about to walk through the exact steps to solve it. You might be thinking this is just a niche paperwork issue, but with millions of people holding digital assets, this is about to become a widespread problem. The good news is, understanding the system is the key to navigating it correctly. If you're getting value from this breakdown, a quick subscription helps us create more content just like this. This is the most critical step. Your personal records are the ultimate source of truth and the weapon you will use to defeat the phantom gain. You must gather and preserve your complete transaction history from every platform you have ever used. This means going to every exchange, even ones you used years ago, and downloading your full transaction history, ideally as a CSV file. These files contain the dates, quantities, and prices of your original purchases. This data is your evidence. Step 2. Master Form 8949. Form 1099-DA is what the broker reports. Form 8949 is what you report. This form, titled Sales and Other Dispositions of Capital Assets, is where you tell the IRS the full story. On Form 8949, you will list every crypto sale. You will enter the proceeds amount from your 1099-DA, which satisfies the matching computer. But then, in the cost basis column, you will enter your actual cost basis from your records. The form then calculates your true gain or loss. Form 8949 even has a checkbox to indicate that the basis reported on the 1099 was incorrect. This is you officially correcting the record. Step 3. Use crypto tax software. For anyone with more than a handful of trades, calculating cost basis manually across different wallets and exchanges is nearly impossible. This is why specialized crypto tax software is no longer a luxury. It's an essential tool. Services like Coinly, TaxBit, and CoinLedger are built for this. You connect your accounts and wallets, and the software automatically calculates your cost basis, tracks your assets, and generates a completed Form 8949 for you, ready to file with your tax return. Step 4. Know when to hire a professional. If your situation is complex, involving DeFi, liquidity pools, staking, or a very high volume of transactions, it is worth hiring a CPA or tax attorney who specializes in digital assets. They can provide guidance on advanced scenarios and can represent you in the event you do receive a CP 2000 notice. Think of it as an insurance policy against a very expensive headache. It's easy to view this as a targeted attack on crypto users, but the reality is likely more clumsy than malicious. This is a legacy financial reporting system struggling to adapt to a new, decentralized asset class that doesn't behave like stocks and bonds. The government is simply trying to close the tax gap by moving crypto from an honor system to an automated third-party reporting system. Now for the good news. This phantom gain problem is primarily a major issue for one tax year, 2025. Starting with the 2026 tax year, the rules improve. For transactions that occur on or after January 1st, 2026, brokers will be required to report cost basis for crypto that is purchased and sold on their platform. This will make the 1099-DA far more accurate in the future, although it won't entirely solve the issue for assets transferred in from external wallets. But for the taxes you file in early 2026, the job of proving your cost basis lands squarely on you. You are the last line of defense for your own financial accuracy. So here is the bottom line. The new Form 1099-DA for the 2025 tax year is flawed. By reporting your gross proceeds without your cost basis, it creates a dangerous trap, the phantom gain, that can trigger automated tax bills for money you do not owe. But this is not a reason for fear. It is a call to action. The 1099-DA is not the final word on your taxes. It is an incomplete starting point, and you have both the right and the responsibility to correct it. Your path to safety is through diligent record keeping. Download your transaction histories now. Use crypto tax software to assemble the data. And understand that Form 8949 is the official tool to tell your side of the story. By understanding how this system works, you are no longer at the mercy of its flaws. You can ensure you pay exactly what you owe and not a penny more. I'm interested to hear your thoughts. Please share in the comments if you've ever dealt with tracking your crypto cost basis, or if you have questions about this rule. And for a deeper look at the software that can make this process much easier, be sure to watch my next video reviewing the top crypto tax tools for 2026. Thank you for watching.